Hi guys, welcome to this channel. I believe finance, science and psychology are the keys to better life. One step at a time, let's create a snowballing effect in our lives. I'll be at your service to research concepts and share them in simple and fun videos. If you find this video helpful, please press the like button and remember to subscribe. It will help me tremendously to grow this channel and keep me going. In the previous episodes, we have discussed how the financial crisis develops, the relationship between stocks, real estates in the boom, and how people's mentality accelerates the process. If you have not watched the previous video, please check out the link. In this chapter, we will be covering 3 financial bubbles from the 10 biggest bubbles we mentioned earlier, and we could see how they linked with each other. These are the bubble in real estate and stocks in Japan from 1985 to 1989. The bubble in real estate and stocks in Thailand, Malaysia, Indonesia, and several other Asian countries from 1992 to 1997. The bubble in over-the-counter stock in the United States from 1995 to 2000. We are not going to discuss the Mexico bubble from 1990 to 1993, as it is a combined result of internal and external factors, including political accidents. Without further ado, let's make our adventure to that turbulent time. Japanese bubble. The bubble in Japanese real estate markets begins in the early 1950s when GDP began to increase rapidly in both nominal and real terms from the sharply depressed values immediately after World War II. The price index for residential real estate in 6 large cities started at 100 in 1955 and reached 4100 in the mid-1970s and 5800 in 1980. At its peak, the value of the real estate in Japan was twice the value of real estate in the United States. The ratio of the value of real estate to GDP in Japan was 4 times that in the United States. During the 1980s, real estate prices in Japan increased by a factor of 10, and stock prices by a factor of 6 or 7. In the second half of the decade, Japan experienced an economic boom. The rate of return earned by real estate investors appeared to be about 30% a year. We mentioned the feedback loop in the previous episode. The increase in the price of real estate fed the boom in stock prices. Bank stocks prices increased a lot as they own large amounts of real estate and stocks. The banks were eager to make more loans because they wanted to increase their size. At the end of the 1980s, the market value of Japanese stocks was twice the market value of US stocks, even though Japanese GDP was less than half of US GDP. The market value of Japanese real estate was twice the market value of US real estate, even though the land area in Japan is only 5% that in the United States, and 80% of Japan is mountainous. The Japanese government faced a dilemma in real estate markets in the late 1980s. Housing price had soared to such a height that only those who qualified for 100-year or 3-generation mortgages could afford to buy. At the same time, any tightening of credits to dampen the boom in real estate would be likely to dampen a remarkable economic expansion. Limiting the house price or credit supply could induce large bank loan losses and cause system crisis. At the beginning of 1990, the incoming governor of the Bank of Japan instructed the banks to limit the growth in the new real estate loans as a share of their total loans. Once the increase of the bank loans increased at a rate of 5 to 6% rather than 30% a year, some investors struggled to get money from the new loan to pay the interest of the old loan. We have discussed in the previous episode when the asset price increases more than the interest due, it encourages the investors to borrow new loan to pay the interest, which pushes the asset price even higher. Financial distress in Japan began at the start of the 1990s and continued throughout the decades into the next one. Japanese industry firms were extremely reluctant to downsize to make the other adjustments needed for their costs to decline. The large decline in real estate values means that many borrowers defaulted on their real estate loans. The bank loans to credit cooperatives and other types of financial firms declined sharply in value because these firms had made real estate loans that were also below water. The customer price level began to decline in 1990 at a rate of 1 to 2% in 1991, and there was concern that a classic debt inflation might develop. With the decline in prices leading to an exceptionally large number of bankruptcies, which in turn resulted in large loan loss by the banks and hence sale of distressed assets, which led to lower price. Summary: the bubble in Japanese real estate resulted from three factors. More than 30 years, the real rate of return of real estate in Japan has been positive at the time. Liberalization of financial regulations in the first half of the 1980s. Japan began to undergo financial liberation, in large part because of pressure from the Americans to open the financial markets in Tokyo, so US firms would have access to clients and customers and trading opportunities in Japan. The Japanese recognized very reluctantly that if Japanese firms were to expand abroad, foreign firms would have to be allowed to expand in Japan. Financial liberalization meant that banks could increase their loans to borrowers who wanted to buy real estate to build new office buildings. The increase in the fund available for real estate loans leads to more rapid increase in real estate prices. Rapid growth in the money supply in the second half of the 1980s because of the intervention of the Bank of Japan to limit the appreciation of yen in foreign exchange market to improve the competitive position of Japanese firms in the first half of the 1980s. Bubble in real estate and stocks in Thailand, Malaysia and Indonesia. In Japan and Asian countries, bubbles in real estate and stocks have generally occurred together. In some countries, especially small countries, the market value of real estate company is a relatively high proportion of the market value of all stocks as a group. In the mid-1990s, real estate prices and stock prices surged in Bangkok, Kuala Lumpur, and Indonesia. Japanese firms and European and US firms began to invest in these countries as low-wage, low-cost source of supply, much as US invested in Mexico as a source of supply for the North American market. China, Thailand, and other Asian countries were on the receiving end of the outsourcing by American, Japanese, and European firms that wanted cheaper sources of supply for established domestic markets. Rapid economic growth were both result and the cause of the inflow of foreign capital, especially from Japan. The buzzword for export-led growth, which was almost always based on the low value of the country's currency in the foreign exchange markets. The domestic lenders in Thailand experienced large loan losses in 1996 because they had not been sufficiently evaluating the willingness of Thai borrowers to pay the interest on their indebtedness. Foreign lenders sharply reduced their purchase of Thai securities. Then the Bank of Thailand, like the Bank of Mexico 30 months earlier, did not have foreign reserves to support its currency in the foreign exchange market. The Bank of Thailand's ability to support the currency at its existing value was quickly exhausted, and in the early 1997, the currency depreciated sharply. The sharp decline of the foreign exchange value of the currency led to capital outflow from other Asian countries. The depreciation of the Thailand currency triggers the contagion effect, and within 6 months, the foreign exchange values of each of the currencies decreased on the Asian arc. What affects the exchange rate of a currency is a complicated question. At the end, it is the classic supply and demand question. Let's say, with a lower price currency, it will help with export, which leads to economy expansion, better investment opportunities. Then, with an inflow on foreign currency, the asset prices will start to appreciate, so as the currency, as there is a higher demand of this currency. But with a change of monetary policy, credit failure, like in Thailand, or political accident, like in Mexico, money will start to flee. Without enough foreign currency reserve, the currency will depreciate, with the sell pressure, which could cause company defaults with decreased asset prices. I will also attach a few links below which I found useful to understand this issue. The bubble in over-the-counter stocks in the United States from 1995 to 2000. The bubble in US stock market prices in the second half of the 1990s was associated with a remarkable US economics boom. The unemployment rate declined sharply. The inflation rate declined and the rate of economic growth and productivity both accelerated. The surge in the flow of capital to the United States, which otherwise can be considered an inflow of savings, initially led to the appreciation of US dollars. It encourages the domestic investments and declines in the domestic saving rate. It led to an increase in the foreign exchange rate and the foreign good price decline in terms of US dollars. And this had the effect of damping the inflation rate. Some viewers may realize that this is why the Federal Reserve now wants to raise the interest rates in the United States. People who then achieve their wealth objectives decline their saving rate and increase their spending, which increases the trading deficit. The data suggested 95 to 97% of the increase in household wealth that followed from the flow of the savings from other countries to the United States was used to buy other US securities, and only 3 to 5% was used to buy consumption goods. Yet the sellers of the securities spend some money on consumption goods as well. The more demand for the securities, the higher the prices is. The increase of investment spending and consumption spending led to an increase in the rate of US economic growth and the increase of fiscal revenues. In the late 1990s, Wall Street security analysts projected that US corporative profits would increase at a rate of 15% a year for 5 years. If that is correct, at the end of the 5th year, US GDP would have been 40% higher than before. In 1994, the stock price declined 4% but increased at an annual rate of 34% in 1995 and 25% in the first 11 months of 1996. The surge in the stock prices in 1995 and 1996 can be attributed to two different aspects of the Mexican financial crisis of 1994. One is direct and one is indirect. Since US was the largest trading partner for Mexico, the depreciation of Mexican peso leads to a trading surplus of 7 billion in 1995 from a deficit of 20 billion in 1994. Thereafter, the change in the maximum trade balance was that there was a capital inflow to the United States, which leads to US security prices increase. Second, Federal Reserve eased the monetary policy. Following the Asian financial crisis, the financial debacle in Moscow, and the collapse of long-term capital management, which resulted in a trade deficit of 150 billion in 1998, the Federal again eased policy. The US stock prices began to decline in the spring of 2000 when Federal Reserve tightens the monetary policy. In the next 3 years, US stocks as a group lost about 40% of their value, with less liquidity in the market, and started with insider selling. The dot-com bubbles is pricked, and investors start to evaluate whether the cash left is enough for companies to survive, and companies start to fail without much surprise and trigger the panic sellings and financial crisis. Summary: an increase in the flow of funds to country induces increase in the prices of both its currency in the foreign exchange and the security prices, and other assets available in the domestic market. The increase in these prices during mania phase of the expansions caused the market prices to increase above their long-term equilibrium values. There developed an increasing reliance on cash from new foreign investments to pay the interest on outstanding foreign indebtedness. Some of the shocks reduced money flows from lenders to borrowers, which everyone knows that could not sustain indefinitely. These crashes were preceded by manias that led to large cross-border flows of money, which caused sharp depreciation of their national currencies, sharp declines in the value of real estate and of stocks during the crash phase of the financial cycle. A decline in the flow of money from abroad almost always leads to depreciation of the currency in the foreign exchange market. In some cases, this decline triggered crashes in asset price of 50 or 60% or more. These large cross-border flows of money to individual countries whose economies were then performing well, which caused the currency in the other country increases. Then the journey starts again. With these three examples, we will go to the next episode to explore more about the international contagion and how our financial system evolved to tackle it.